How do we actually measure success in strategic management? At the end of the last session, we looked at the strategic management process. And at the beginning of this process, we said we would set a goal or an aspiration of what we want to achieve. And hopefully at the end, after we go through the entire strategic management process, we would end up with above average returns. So hopefully with achieving our goal and our aspiration. In today's session, I would like to look at ways of how we can measure strategic success. We will look at EVA, or economic value added, as one potential measure for strategic success. And towards the end of the session, we will talk about drivers of above average returns and how we can achieve above average returns according to two academic models that we will look at. So let's start by looking at the ways of measuring success in strategic management. And there's really a number of ways of how we can measure, and I would like to introduce a couple of those that I could think of. The first and probably easiest also to measure is sales or revenues. So we would just take from the profit and loss statement or the income statement of the company the total sales or the total revenues generated by the company in a given period. This one is easy to do. It's easy to compare across firms, but it doesn't really say much about the profitability of those sales. It's easy to get sales quickly by just dumping the price, but whether it's profitable or not, we don't know. So maybe not a great measure for strategic success. Now, how about profit? So operating profit, EBIT or EBITDA. That's also easy to measure. We can see that from the profit and loss statement. But EBIT and EBITDA can be manipulated with creative accounting measures. So they can vary quite significantly in different years, depending on accounting treatment of specific items. Now, the next one, net profit after tax, is a little bit clearer. It represents the net results of the business after all taxes and after all financing costs. But still there's something missing. It doesn't give a clear indication of what investments were needed to achieve those results that were reported as NPAT. So still some missing aspects. Now, we could also look at market share, which is basically the share of the company's revenues as a proportion of the total revenues generated in the market. It's a good indicator for the relative power vis-a-vis other companies, but it largely depends on how wide or how narrow we define the market. We could define the market as very narrow and then we would be market leader, or we could define it as wider and then there would be other companies coming into play and we might no longer be the market leader if we take a wider definition. Again, there is no indication of the profitability, same as if we look at sales or revenues. And market share is sometimes not so clear, it's sometimes difficult to measure, especially if we deal with a lot of non-listed companies that don't follow the same reporting standards as publicly listed companies. Now, when we talked about NPAT, we mentioned that there's no indication about the investment. Now, what about ROIC, so the return on invested capital? That's slightly better because it takes the invested capital into account and puts it into relation of the net return of the company. It's also easy to compare across companies and easy to compare across industries because here it's a ratio that we look at. But still, there's no indication of the cost at which the capital resources have been acquired. So still a missing aspect. So there's a couple of other aspects. Well, before we go into more details of the cost, what about the share price? That certainly takes everything into account, right? Well, it's easy to measure. It's available on a daily basis, fully transparent. It's a key metric for the owners of the company who can look up the share price every day at any point in time. However, the challenge with share price is that share price is quite dependent on performance relative to market expectations rather than the absolute performance. So if the expectations were very low and the company outperforms those expectations, the share price might go up and might make a big jump. If the company still performs very strongly, but the expectations were just much higher, then the share price might actually drop despite a very good reported result. Plus, in addition to that, the share price is often subject to speculation and therefore maybe not a good measure of strategic success. Total return to shareholders is quite similar. It takes the dividends into account and also the dividend or the interest on the dividends paid over time. So the good thing about total return to shareholders is it looks at a longer period of time, and it takes the relative performance as well as the absolute performance into account. But we haven't taken care of the subject of speculation as well of the expectations and the management of expectations by the market. Some companies are measured by completely different measures, like the number of customers or the number of subscribers, especially e-commerce companies or subscription-based companies. So that can be quite a useful metric in those cases, especially if the company doesn't have any significant revenues or profits yet. But again, because there is no indication of revenues or profitability of these customers that come in, it doesn't really measure strategic success either, or is only partially a good measure for strategic success for these companies. Now, to go completely out of the box, we could look at company reputation as well. So we would measure customer sentiment through surveys or through polls, opinion polls. That can be actually a pretty good medium and long-term indicator for the sustainability of the company and the sustainability of its customer base. But again, there's no direct relationship to sales or profit. And this requires a thorough research methodology to be really credible and to give a good indication of where the company really stands. Now, one measure, and this will be the one that I would like to look at in more detail, is economic value added. It's also referred to as economic profit, and that is a well-rounded metric of profitability and invested capital, and it also takes into account opportunity cost. The challenge with this one is, while it is a very good measure for strategic success, it is not very straightforward to assess, and we have to go through many steps to get to economic value added. So in the next step, I would like to introduce economic value added a little bit further and would like to look at how to actually calculate economic value added. So economic value added or economic profit can be measured as the revenues minus the explicit costs minus the opportunity costs. So it also takes opportunity costs into account. So if you look at this example here of opening a restaurant, let's assume we have revenues of $100,000, and then after deducting all the cost of goods and labor and space rental, marketing expenses, we end up with an accounting profit of $10,000. So it's a 10% profit ratio. Not too bad. But if you look at what else we could do during the time of opening and running this restaurant, for example, having a full-time salary job, we might earn $40,000 a year in that job. So actually our economic profit from operating this restaurant is minus $30,000. So it's a negative economic profit if we take into account the alternative or the opportunity costs that we have from operating this restaurant full time. Looking at how companies look at economic value added, EVA. EVA is defined as the net operating profit after tax, or NOPAT, minus the invested capital times the cost of that capital, so the weighted average cost of capital, or WACC. Here in this example, maybe we have a company that has an operating profit of $1 million, and then with 30% tax in the US, the company would be left with a net operating profit after tax of $700,000. Now, that seems quite a good number, but if you look at that, it took $10 million of investment to come up with these $700,000 net operating profit after tax, and that this investment comes maybe at a cost of 8%, then the total cost of capital would actually be 800,000. And with a net operating profit after tax of 700,000, we would have an economic value added, or an economic value loss, I should say, of $100,000. So given the opportunity cost of $800,000 with the invested capital, it would have been wiser to invest the capital in something else. Finally, if we come up with the economic value added, we still have to compare this number to other companies in the industry to find out if we are above average or not. The consulting company McKinsey did a study of 2,393 firms globally, and they measured that economic profit. So they looked at the invested capital, and for these 2,393 firms, the average invested capital stood at $9.3 billion US. And with this invested capital, the companies produced a net operating profit of $921 million on average. So the ROIC, or the return on invested capital, was about 9.9%. But to achieve these 9.9%, there was a capital charge of 741 million, or on average 8% during the period of 2010 to 2014. And that left the companies with an economic profit of 180 million, or 1.9% of the invested capital. Now, next, I would like to look at ways of how we can actually measure this and make this very practical, of how we can measure economic profit in practice. So here's the formula. The economic value add is net operating profit after tax minus the invested capital times the weighted average cost of capital, or WACC. So if you break this down, the net operating profit after tax is fairly easy to assess. So we take the operating profit that can be found in the income statement, or the EBIT. We get this from the P&L, the income statement. For the tax rate, we use the marginal tax rate. The company normally reports an effective tax rate, so the actual tax that the company pays. This can vary depending on the year and depending on tax savings measures that the company puts in place. So it might very well be lower than the marginal tax rate, than the real tax rate that is officially announced, or that is law in the country. But we use, in this case, the official corporate income tax rate of the country. So that is called the marginal tax rate. In Thailand, that would be 20%. That's the corporate income tax rate here in Thailand. So, and then we take the operating profit and deduct the tax, and that gives us the net operating profit after tax, or NOPAT. Now for invested capital. The easiest way of assessing this is to look at the balance sheet and taking the book value of equity and the book value of debt. Now, I would like to propose here that a better measure for the invested capital is to take actually the market value of equity and the market value of debt, because that reflects the cost and the magnitude of the capital that would be needed at this point in time, not some years back when the actual debt and the actual equity was raised. So the market value of equity is calculated by the share price times the number of shares outstanding. Both we can find in the annual report of the company. The market value of debt is a little bit more complicated to assess, because first of all, it includes all the interest-bearing debt and also all the lease obligations. So we need to look in the annual report and need to assess both the interest-bearing debt and the lease obligations. The market value of the interest-bearing debt can be assessed by looking at the book value of the debt and then applying the the formula that is shown here. I don't want to go into the details. So in any corporate finance course, you will talk about the bond valuation formula. But here's the formula. And I will show you some examples of how to calculate this. And then for the value of operating leases, we would have to look at the lease commitments and discount that by the pre-tax cost of debt. And the pre-tax cost of debt is the risk-free rate plus the default spread of the country plus the default spread of the company, which I will also show you later in the example. Now, in the formula, we have not looked at the WACC yet, so we have to look at this separately, because that's also another step and a more complicated step to assess. So weighted average cost of capital is calculated as the cost of equity times the weight of that equity as proportion of the total capital, plus the cost of debt times the weight of that debt as proportion of the total capital invested. So for the cost of equity, it is basically the risk-free rate, which is, for example, the 10-year government bond for a AAA rated country such as the US or Germany. That's the risk-free rate that we have in the market. And then plus the beta of the company times the equity risk premium. So the beta of the company can be found on platforms like Yahoo Finance. And the equity risk premium, that is something that we can actually look up. It's calculated on an annual basis by Professor Damodaran from NYU Stern School of Business. And we can look it up on the website. He calculates that on an annual basis, usually in January or February, at the beginning of the year, for every country. Now, for the cost of debt, that is the risk-free rate, again, same that the AAA rated country, risk-free rate, a 10-year government bond typically, plus the default spread for the country. That can also be looked up by the database of Professor Damodaran from NYU. It's online available for free. And then the default spread for the company. Now again, here we need to go through another hoop, which is to look at the synthetic credit rating of the company and assessing what is the default spread of the company. And for this one, we need to take two further steps. We need to look at the interest coverage ratio, which is the operating profit of the company divided by the interest expenses. So it basically says how many times can we cover the interest expenses through our operating profits. So we get a multiple. And then again, Professor Damodaran from NYU Stern publishes a table every year with a synthetic rating based on that default spread. So for example, if based on that interest coverage ratio, So basically, if we have an interest coverage ratio of 10, then in this case, the rating would be a AA for a low market cap firm, and that would result in a default spread of 1%. And low market cap firms here are defined as companies with a market cap of less than 2 billion. Now, all of this seems very complicated, and I would like to end this explanation with a quote from Charlie Munger, who calls the desire for having some, what he calls false precision in finance as the physics envy. So basically saying that, academics in finance envy their physics colleagues and would like to produce something that is as accurate, as precise, and as complicated as some of the formulas in modern physics. But he also states that this doesn't happen in economics typically. The economic system is too complex, and therefore all these calculations that we do give us overconfidence in the accuracy of the numbers. So I would like to put this here to say, like, you can do all these complicated calculations, for example, for estimating the market value of equity and the market value of debt, or you can also just take the book value from the balance sheet, which is much easier to assess. Now, after these complicated calculations, I would like to show you some example to make this a bit more practical. And here I looked at the basic materials industry in Thailand. So first I calculated, and you see here 6 companies that are in this basic materials industry and listed in the SET 100, so in the 100 biggest companies in the stock exchange of Thailand. We can calculate, we can find the information on finance.yahoo.com about the operating income with the corporate tax rate, the marginal tax rate of 20%, which is the same for all these 6 companies. We can calculate the net operating profit after tax. Then the market value of equity can be calculated by the share price times the number of shares outstanding, which both we can also find on finance.yahoo.com. Then we can use the formula that we have just discussed to calculate the interest coverage ratio. So again, interest payments are also stated on finance.yahoo.com for listed companies. I looked up the risk-free rate, which is the 10-year US Treasury bonds. Right now in August 2021, it stands at 1.35%. Thailand has a credit rating of Baa1. And with that, according to Professor Damodaran from NYU Stern, this leads to a default spread of 1.55%. And all of this together with the default spread of the company, this gives us the pre-tax cost of debt. I looked up in the annual report the remaining lifetime of the maturity of the outstanding debt. So basically, when do the companies have to pay this debt back? So you see here this ranges from 1.1 to about 3.6 years. So this is time measured in years. And with this, using the formula, we can calculate the market value of the debt, which differs slightly from the book value of debt. The beta and the equity risk premium we can look up for Thailand. The beta can be looked up in finance.yahoo.com. It's reported there for the company, for each company. And that gives us the cost of equity. So basically the return that shareholders of that company would demand given the risk profile of the company. And from the pre-tax cost of debt, we can also calculate the after-tax cost of debt. So doing all the calculations in a simple spreadsheet, we can calculate the net operating profit after tax by using the formula. We can calculate the WACC, weighted average cost of capital, and we can calculate the invested capital. We see here now that the economic value added for those 6 companies varies quite significantly. So PTT GC, for example, has, as of August 2021, an EVA of about minus 13.3 billion Thai baht. Siam Cement Group, for example, SCC, has a positive economic value added of 3.7 billion Thai baht. And Tasco, which is Tipco Asphalt, an asphalt company, has an economic value added of 3.178 billion Thai baht. Now, the number itself is interesting, but it becomes more interesting if we look at this in proportion to the actual invested capital and look at it as a percentage. And then we see here that the seemingly big number, a negative number of EVA for PTT GC, PTT Global Chemicals, is negative 3%, while the 3.2 billion of Tasco are actually representing 9% economic value added. So now if we look at above average, or above, in this case, above the median. The companies SCC, Tasco, and TOA would be above average, and the other three companies, EPG, Indorama, and PTT Global Chemical, would be below average. So you have three companies above average, of course, and three companies below average, and we get a fairly good view of the industry here. Now, finally, I would like to conclude this session by looking at two models of how success in strategic management, so how above average returns actually can be achieved. The first model I would like to look at is called the industrial organization model. And basically the industrial organization model, in very simple terms, says that the external environment is much, much more important than managerial choices. And the model itself makes four assumptions. The first is that the external environment limits strategic choices. The second one is that firms control very similar relevant resources and pursue similar strategies. So the resources across companies are actually quite similar. The third assumption is that resources are actually mobile between firms, and therefore any advantage that a company has in terms of resources is only short-term. And we can think of this as managers, for example, that can move from one company to the other if they get a better offer at the competitor company. So those short-term advantages that a company might have from having a stronger management team might only be short-lived. And finally, the fourth assumption is that decision makers are rational. They act in the firm's best interest, which is profit maximization, and therefore those managerial decisions, those managerial choices are basically all tending towards the same level across companies. So the basic idea of this model is look for an attractive industry to operate in. And the proposal of academics that follow this kind of framework of thinking, the industrial organization model, say that first you have to study the external environment. That's the very first important step. Then you look at an attractive industry that you want to play in. And if that industry is not your industry right now, then you should put an effort in to change your industry if there's another industry that is more attractive. Then you formulate your strategy for that industry. You develop the skills, you acquire the resources, and then you implement your strategy, so you take action on this one. So this one was the industrial organization model, the first model that we will look at. The second model is the resource-based model. It's the absolute opposite of the industrial organization model. The resource-based model suggests that resources are key for gaining a competitive advantage. So it's all about the resources that you have available in your company. And there are three assumptions. The first assumption is resources and capabilities are really unique. Think of the engineering talent that Steve Jobs had in Apple. Right? They created something really unique and advantageous for the company that competitors took actually years to get even close to. Organizations are simply a collection of resources and capabilities, and therefore it's all about those capabilities because they make up the company really. And the third assumption is that those core capabilities become actually core competencies, and these are fundamentally strategic important. And therefore, the basic idea of those who propose the resource-based model is get the best resources. And these are the steps. First, we have to identify what these resources are. Then we need to get those resources in and build the right capabilities. We need to determine what is really the competitive advantage of the resources that we have in place. And then we look at the industry and then formulate and implement our strategy. So the starting point for this resource-based model is fundamentally different from the industrial organization model insofar as it starts out with the resources and the attractive industry is only secondary. It plays a role, but is only secondary here. So now that leaves us with the question of which of these model actually works better. So if we would have to choose, which model should we actually look at? And I would like to give you 2 data points here. The first one is from the same McKinsey study that we already mentioned earlier, the 2,393 companies that McKinsey looked at for the period of 2010 to 2014. And McKinsey here looked at the average annual economic profit within each industry. And as you can see here, industries vary significantly in terms of the economic profit that they generate. So, for example, if you are in the software industry, the likelihood that you have very high positive economic profit is much greater than if you are, for example, in the electric utilities industry or in the construction materials industry. Now, still, of course, as a company, you can outperform in the electric utilities or the construction materials market, but it is much easier to generate positive economic profit if you are in the software industry or in the telecom services industry or in the automobile industry during that time. So what this suggests is that maybe the industrial organization model has a stronger impact on the economic value added created by companies than managerial choices. So even the best managers in the electric utilities or in the construction materials industry will struggle to create positive economic profit. Now, another model, slightly older, is by McGahan and Porter from 1997, who studied the influence on profitability across multiple companies as well. And in their research, it came out that actually the resource-based model maybe outweighs the industrial organization model. So if we look here at the corporate parent effect and the business unit effect together, which is maybe an indication of resources and the management skills and capabilities of those companies, it by far outweighs the industry effect and the year effect together, which would be external influences. And have to note, though, that there's a big portion in this study came out as unexplained variation, which are things like economic crisis, for example, that cannot be controlled, or natural disasters, changes in consumer taste, and so on. So you could also call it luck or bad luck, good luck or bad luck. So a big portion is unexplained. But if you look at the explained portion, it seems like the resource-based model actually has a point and seems to outweigh the industrial organization model. So now that we looked at ways to measure strategic success, we can now look at the industry that our company is in, and we can compare as a starting point the current state, the starting point of the company in terms of the economic value add compared to its peers. And that builds the basis for the aspiration that we want to set. And then we can dive into the strategic analysis.